Hey there, everyone. Happy Tuesday, April 1st, 2025, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast, kind of rainy, kind of classic early April day here in Redmond, Washington. Hope you all are doing well. The market's chopping around, sort of the calm before the storm, as it were. Impacts potentially of tariffs taking place or kicking off tomorrow. Still very much an open question. The market sort of up and down through the course of the day. In the end, the major averages, most of them finishing slightly higher. But this was sort of a let's hold our breath and see what happens tomorrow kind of day in the markets. Interesting time to be reviewing the market conditions. We're going to go through the market recap here in a moment, and then we will go through the heat map, go through some charts, take a couple questions. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. And I appreciate you so much, those of you that are tuning in live. You can ask questions all along the way on any of those platforms. Just put it in the comments section anywhere you're seeing the stream, and we'll try to take a question or two at the end of the broadcast. Anything we don't get to, we'll put in our mailbag. We're planning an all mailbag episode Friday of this week. Going to be kind of an interesting one because I'm traveling to San Francisco for the CMT West Coast Summit. And hopefully maybe I would see a couple of you there. I don't know if anyone would be attending. But should be a lot of fun to reconnect with some other professionals, many from the West Coast, and I feel like post-COVID we haven't gotten together enough. So very much looking forward to that. Before we get to the chart, so I do have a special announcement. We're changing the name of the show. The name Chart This was kind of a temporary name from the beginning, just until we could come up with a better name. Thought this was a great time to announce. Our new name is actually This Chart with Dave Keller CMT. I thought that was a better way of describing the general approach. We really focus on individual charts and their takeaways. So that name change is effective immediately. Again, really, I think better describes the point of the show. Totally kidding. April Fools had to do something. Thought that was an easy. It was fun to change the thumbnail, though. I hadn't changed that thumbnail in a long time. I just usually go in and change the date every day. So that was exciting. But no change to the name. I think it's a pretty good one. And by the way, quick trivia. If you want to know where that name came from, I had a couple names and I was floating them by my wife. We were eating lunch the one day and she looked and said, "Why don't you call it Chart This with Dave Keller?" And I'm like, done. That's the name. All right, let's keep going here with our market overview. Kind of mentioned that choppy nature to the markets, and today very much it. Yesterday, very much like an accumulation day going into the end of the quarter. Q1 now behind us. This is the first trading day of Q2, and really sort of a choppy, sloppy, sideways day. The S&P 500 finished 0.4% higher. That's just above 5633. The Dow actually just a touch lower, 11 points lower. That's not much. So just below 42,000 right now. The NASDAQ composite just below 17,450, and that's up 0.9%. So the NASDAQ actually did end up having a decent day. That all came in the last hour of trading, though. Up until then, we're basically flat for the day. You can see mid caps and small caps finishing slightly higher as well. And the VIX pushing slightly lower, still above 20, still above our kind of general threshold for high volatility versus low volatility. So generally we're seeing the market still, I think, in a vulnerable position here. Makes sense that we're having a choppy day, sort of an unclear direction going into tomorrow's I guess tariff week, we'll call this. Sort of the big news of the week, to see what the potential impacts are. To be honest with you, the market's not pricing in much of an impact, and you could say, well, they already sold off a bit. I'd say there are a lot of reasons why they could have while they sold off. I think the tariffs are part of that, and is that really priced in all the potential negative impacts? But again, it's very much unclear at this point. So volatility remains high. Markets, I would say, as measured by things like our market trend model, in a vulnerable position. We'll go through the charts there individually here in a moment, but let's look at some of the other asset classes and see what they're doing. Bonds generally moved higher today. The TLT was up 0.9%. I did grab a chart of the TLT to show you. I mean, it probably described as a symmetrical triangle pattern, although it's not ideal. But I think it best describes sort of this consolidation phase we're in, very close to breaking out. And I think that's one emerging trend to look for through the remainder of this week. If bonds do manage to break higher, it'll push things like the stock to bond ratio much lower. That's been in a primary uptrend for many, many years. I'll grab that chart as well so you can see what I mean. No real change to the dollar, but with bond prices going down, yields generally move lower. So you can see the 10-year yield finished today around 4.15. The long bond yield just above 4.5%. The 5-year point now kind of well below 4%, right? Almost to 3.9%. Looking at the commodity space, the DBC flat for the day, right? So the DBC is a broad commodity ETF. It's more energy than anything, but does combine a bunch of different commodities into one ETF package. Gold and silver, the precious metals part, moving lower. You can see silver, one of the worst performers, down about 1.2%. Crude oil prices slightly lower today. Natural gas prices down in a pretty big way. Energy stocks actually didn't do too bad in terms of their position relative to others. Looking at the cryptocurrency space, you can see Bitcoin over the last 24 hours kind of moving higher. Did dip down to around 82,500, but through the equity trading session, managing to push to the upside. Currently sitting above 85,250. That's up about 3.3%. Ether prices above 1,900. That's up about 5%. You can see most of the top 10 cryptocurrencies on the stock charts platform in the green today. In terms of sector breadth today, 9 of the 11 sectors actually finished in the green. Consumer discretionary, the XLY was up 1% today. That's your best performer. Technology, number 2, up 0.7%. Energy, number 3, tied with industrials, basically around 0.6% higher. So what's interesting here is consumer discretionary and technology, arguably 2 of the weakest sectors in 2025. I mean, if you look simply at the relative performance of the 11 sectors, I'm pretty sure those are your 2 worst performers. I think that's probably fair. Technology has been a chronic underperformer. Consumer discretionary has been a chronic underperformer. Everything else has done a lot better. And the rest of them are actually, I believe, up on the year and have outperformed the S&P. But those 2 have underperformed pretty consistently. So certainly a bit of a counter trend feel to the action today when you look underneath the hood with the XLY and the XLK, your top 2 performers. On the bottom, healthcare, actually the worst performer, down 1.8%. Financials just slightly below 0, and communication services about flat for the day as well. Where else can we go? In terms of breadth, kind of mixed, to be honest with you, but generally more advancers than decliners. If you look at the New York Stock Exchange, about a 2-to-1 ratio almost of stocks up versus down today. In the S&P, a little less, but still pretty good. 59% up, 41% down. The only real outlier here is the NASDAQ composite, where 52% were down, 45% were up. So in the growthier stuff, less strong in terms of the breadth conditions, but generally today was a decent update. Now the breadth over the last week has been fairly negative, so this is kind of an unusual day that the breadth was actually so positive, but it is what it is today. Looking at the Magnificent Seven and friends, we have Tesla up 3.6%, Microsoft up 1.8%, Meta up 1.7%. Now, what's interesting about Meta is that it is actively testing its 200-day moving average right now. Arguably, Tesla kind of trying to as well, but charts like Microsoft and most of the others just flat out well below their 200-day moving average right now. I don't know how I got an extra NVIDIA in there. I'm going to have to check that one. Making a note to myself. Anyways, what else? On the downside, the worst performer of this basket, Apple, still up 0.5%. So you can see that the Mag 7 names actually had a decent update. That's why your major averages finished in the green, because the big dogs were actually getting it done and moving to the upside. Those have been lagging big time, certainly in the month of March. All right, let's go to the heat map and see how things played out today. As a reminder, I do see some questions coming in. Can keep them coming, and we'll take a question or 2 at the end of the live stream. Any of the questions we don't get to, we will put in the mailbag. We've had some really good mailbag episodes. If you hopefully you've been watching those, but last Friday, some just really great questions. And that Friday episode allows me to spend a little more time answering questions that are asked during the week. So please keep them coming. All right, looking at the heat map here, I mean, the obvious standout, in my opinion, healthcare sort of down. I mean, out of all of them, clearly the worst sector here is this one. And you can see it's names like Eli Lilly, Johnson & Johnson down almost 8% today. Boy, I missed that one. So let's go there real quick. Boy, I do my best to grab every chart I can, but then something like this pops up And I go, ooh, that would have been a good one to highlight. Boy, Johnson and Johnson gapping lower in a pretty big way. Now you had news about Department of Health and Human Services with mass layoffs kind of kicking off here today, and maybe that's part of this story. I haven't dug into this much, but from a technical perspective, I think Johnson and Johnson is really testing a key resistance. I mean, this is a name that's been range bound for quite some time. This is the weekly chart that I'm looking at just to kind of highlight that sideways trend. Now, here what I did was I took the unadjusted data, because something that has a pretty high dividend like this, I like to look at the unadjusted data. On stock charts, you can add a little underscore before the ticker, or below the chart, you just click on where it says adjust for dividends, and that takes the dividend adjustment out. Now you can see that we're actually pretty far below the 2022 highs. But in the last month, right, going back to late February, early March, we're retesting the summer fall peak from August, September of last year. That was around 168. You can see that's pretty much where we traded up to. So we bounced off of support around 145. That's where we bounced support in fall of last year, in the summer of fall of 23, that is, spring and summer of 24. Now end of 25, undercutting briefly, but really ended up bouncing off of that level back up to test the swing high. So this really is just this big sideways pattern, right? A big consolidation pattern. So the challenge is Johnson & Johnson looked like a really compelling breakout name and got up to 170. So just briefly getting above there, but now starting to rotate right back over. So Johnson & Johnson all of a sudden looking, changing from what could be an encouraging chart to very much not so much. Now, other pharmaceutical names like, let's see, Merck, Pfizer have been in pretty ugly trends here. These have been charts that have been underwhelming for quite some time. So I don't think it's news that Pfizer is going down again, because we've seen all of these sort of stalled breakouts here. So, for example, on the chart of Pfizer, January, another January high, early February, late February, early March, all kind of hitting the 200-day moving average, all hitting $27 a share, not getting it done. This is why we focus on key resistance levels, and often for me, set entry points, triggers, alerts just above, right? So a lot of times when I say I'm going to set an alert, like on this chart, I jot down Pfizer over 27, because that would finally mean we're breaking above that level. And until then, it's just not a chart I'm going to get excited about. Now, at some point, maybe you need to adjust those triggers and adjust the levels that you want to pay attention to. But for now, I feel like Pfizer, until and unless it can get above 27, there's just probably better charts out there. And note how when we tested resistance there, that the RSI stalled out around 60 that whole period. So the first quarter was really just an underwhelming quarter. And again, I mean, what's good about Pfizer is it wasn't going down, but what's bad is that it really wasn't breaking out, right? Higher highs and higher lows are an uptrend. That's not what we see here. We see highs that are not getting higher, more of a lack of follow through. So the healthcare space certainly showing some negativity today, and certainly more than the rest of the market. Other big areas of red. So on a day when generally the markets were higher, I would say the average name here is kind of neutral color. So what stands out with the big green days kind of jump off. So like a Tesla, Chipotle, Ralph Lauren up. These are the names that sort of jump out, but also the big red names. So within communication services, a couple names like Interpublic, Omnicom, OMC, WBD, Warner Brothers Discovery. Those first two, I would say from a technical perspective, have been ugly for a long time. Warner Brothers is one of those that actually looked like it might be recovering, kind of like Pfizer. If I would describe Warner Brothers from a technical perspective, I'd probably label it as a symmetrical triangle or a coil pattern. That is when you have a consolidation of the range, right? You have a clear downtrends of lower lows and lower highs. You have clear uptrends of higher highs and higher lows. But what if you have lower highs and higher lows, kind of a consolidation? Best way to describe that is a coil pattern or a symmetrical triangle that basically says we're treading water. It's wait and see mode. And this is one of the easier chart patterns to play, because it's basically wait and wait for a break. At some point, this trend is going to change, right? The pattern is going to be broken. either with a break above the upper boundary or a break below the lower boundary. And I think whichever way you see that break, that's the one you want to follow. For now, it's sort of wait and see mode. So this is the type of chart, if you trade options and you can do something like a straddle or strangle or some way where you're betting on the price to stay within a range. That's, I think, where these patterns can be super valuable. And I've talked with people like Sean McLaughlin and Jay Soloff and other kind of options experts that I brought on my podcast about those consolidation patterns, what kind of moves to what kind of option structures can help you take advantage of it. But if you're more of a plain vanilla stock person and you're just looking for trends, this is the absence of a trend. This is a sideways market. The momentum is essentially neutral with the RSI rotating between 40 and 60. I think you wait on a chart like this for a decisive move one way or the other. What else stands out? The other thing I wanted to highlight on the heat map were airlines, right? And airlines looked really interesting. Not Delta, which looked pretty bad, but like I'm thinking of Southwest, which, I mean, talk about a sign of the times. I mean, charts like Southwest look encouraging. And when I see the break, the gap higher above the 200-day in early March, and then the continued follow through, so there's a gap and then an additional increase. We're getting up to those previous highs from December, and this looks really encouraging. Again, this is where I set an alert and say, when we get above that high, that's really positive, because we stalled out around 34 back here in February, March of last year. We stalled out right around the same level. And now, once again, we've traded up to that resistance and now failed. And so today, down about 6%. A lot of the other airlines have already been more in negative trends going into to today, like Alaska Airlines, right? Peaked out in February, and it's just kind of been in a free fall. Southwest was kind of an outlier in that it was actually retesting a high from the fourth quarter, but today kind of following everything down. I mean, airlines have been struggling with sort of the weaker consumer sentiment, weaker demand for air travel. All of those headlines are really kind of coming off of resistance. This is a great example of why you focus on resistance levels and patiently wait. Tesla, I'll highlight Tesla. I did grab two of the FANG names, but not Tesla. We'll take a look at Tesla here very quickly, just because I want to make sure we discuss it. I mean, I would say with the chart of Tesla, it reminds me very much of the charts of, Meta and others. They're kind of the 200-day moving average is being tested. Paul Tudor Jones famously said, nothing good happens below the 200-day. Tesla, for now, is a chart failing to get above the 200-day moving average. I love to just wait for a chart like this to regain the 200-day, and then you reconsider it. Until then, it's like any sort of bounces are nice bounces, but until it can get above that, what I call the long-term barometer, the 200-day moving average, there are just other things that are looking better. I mean, way better than a Tesla. And I'll highlight some of those as we go through the charts today. There are just other charts that are in better primary uptrends. This is not a primary uptrend, right? It's making lower lows, and arguably this is another lower high. The question is, where do we, what happens now? We're sort of chopping around between 220 and the 200-day moving average. Let's see which one breaks first. But until we can get the Tesla above the 200-day, I'm sort of waiting. This is one of those, honestly, where I scan for stocks breaking above their 200-day just so I don't have to follow Tesla all the time and say, oh, did it break? Did it break? Did it break? You put it on a list. You check for stocks breaking above the 200-day. Those are the ones that are actionable. A lot of times when I'm asked about particular tickers, the answer sometimes is it's not giving you a clear read yet. You don't want to force charts and say no matter what, is it bullish or bearish? Sometimes it's just sort of Carter Worth, who's I used to follow his work closely in my Fidelity days. He's a CNBC contributor as well. And he would say it's a pair of twos. It's okay. I mean, it's not a bad chart. I mean, there are worse charts, but is it that good? I mean, do you really want to build a portfolio around a pair of twos? And if you know poker, that's like the weakest actual poker hand you can have besides nothing is like a pair of twos. So it's a pair of twos, right? And it's okay. But I'm not going to bet much on a pair of twos. I'm going to wait for a better opportunity. So charts like this tell me look elsewhere, look for better opportunities, and we'll see. All right, let's continue on with the chart review, and we'll go through the charts that I've prepared here. We're going to start with a daily chart of the S&P 500. For now, 5,500 holding. That's where we hit on an intraday basis yesterday. My thinking today was, do we actually hold it? And we did. We chopped around quite a bit, but the S&P did finish slightly higher, finished above 5,600, and that does, appear to be, at least for now, what's looking to be a double bottoming pattern. I interviewed Craig Johnson of Piper Sandler. We spoke last Thursday before that rollover into last weekend. He said, I think the low from March, I think 5,500 holds. I think that's the low. And for now, it's looking like a pretty good call. We'll see what happens. But for now, I mean, it's holding. And I would encourage you to listen to that interview, by the way. He was, he's thinking a lot more about the long-term trends, which I absolutely respect. And when I talk to someone like Craig Johnson or Ari Wald of Oppenheimer, or who else is in this bucket? Guys that bring up this long-term data. Ryan Dietrich of Carson, former of LPL Financial. What's consistent with each, those are actually three very different analysts. I don't want to group them together too much, but what they each do consistently is when the market sells off, they often bring these great reminders of, hey, if you go back in time and if you generally buy when the market's down 10 to 20%, 12 months later, you're almost always higher, right? You're almost always better. Now, there's a chance we have a 1970s secular bear market that takes years and years to recover, but that is a one very rare occurrence. Most of the time, pullbacks of 10, 20, even 30% end up being really good times to be long as your runway is long enough. And so Craig actually shared some data about, right, here's what happens when the sentiment's this bearish. Here are the average 12-month returns after the market has done kind of what it's done now. And I think that was a great reminder. I'm, at this particular moment, pretty bearish in terms of the information I've been observing, my analysis of the charts. And I really appreciate talking to someone like Craig, who has a much more optimistic way of thinking about this current pullback phase. So listen to that. That was the latest episode of the podcast. And I did actually speak with Miss Schneider earlier today. That's not ready. That'll come out today, maybe tomorrow morning, but we talked about a lot of different things, including tariffs and a lot of charts, particularly agriculture and commodities. So don't miss that one when that one comes out as well. So for now, I mean, how do we read the chart of the S&P? I mean, generally, I see this as a bearish structure and that we broke below the 200-day. We tested that from below with this beautiful evening star pattern, confirming that resistance and rolling over. For now, we're holding 5,500, which was our downside target when we start breaking down here. Run Fibonacci retracements off the December peak, and I get 5,500, which ended up being a pretty decent objective for early March. That's tested yet again. I think that just validates the fact that 5,500 is clearly where buyers are coming in and thrilled to own stocks, which means if and when we break below 5,500, that's where I think we can start to decline pretty aggressively. But for now, we'll see if that holds. The VIX chopping around quite a bit yesterday, also today. Not much of a change, to be honest with you. Ended up closing right at the 50-day moving average, right around 2170, 2180 or so. So VIX remains above 20. We're kind of mid-range of where we've been over the last 6 months, right? If you look at the last 6 months, which is what we're zooming in here, upper end around 28, 29, lower end around 13. We're right at 22, which is kind of right in the middle of that sort of general range. So, we're above average, but we're still really not in an extreme reading relative to where we've been the last 6 months. The VIX levels are important to me. The ranges, right, what we call the VIX volatility regimes, are also pretty important. So now we kind of have a new framework where when the VIX gets up in the upper 20s, that's ended up being some pretty decent buying opportunities. The VIX getting down in the low teens is where you want to start to think about, maybe a reversal of sorts. Right now, we're kind of middle of the road for the VIX in the last 6 months. I mentioned the symmetrical triangle, what we call a coil pattern on the TLT. This is a bond prices, the Treasury bond ETF. Treasuries on the longer duration side, so the longer end of the curve. Probably describe this as a symmetrical triangle. It's not a perfect one. It would be better if this was more filled out, but you can draw a trend line from the December high and the late February high, which lines up pretty well with where we were at today. So I think breaking above 92, breaking out of that pattern on the TLT would suggest stronger bond prices, lower bond yields or yields remaining relatively stable to slightly lower. But overall, the momentum is more constructive. The trend line off of the lows was broken about a week ago, but immediately reversed higher. So that's a failed breakdown, continuing higher. So overall, I mean, it's sort of consolidating, but it seems to me as if the general trend is higher with positive momentum. So I think overall, stronger bond prices, and that's another sort of making me think with the inverse relationship we've observed so far in 2025. Maybe that's the safe haven that investors rotate to. This is a very long-term chart of stocks versus bonds. I was inspired to do this because earlier today I released our April monthly chart review, which is only for my market misbehavior premium members. That's a monthly exercise we do. We apply the market trend model to a bunch of different ETFs and asset classes. We look at performance statistics to look at which different ETFs, looking at indexes, equities, other asset classes, style, size, etc., how they're all performing relative to one another to make sure we understand what's working and what's not. And then we look at sector relative performance. This is one of the about 50 charts we go through every month to just focus on what has evolved from one month to the next. If you want to be a part of that next monthly chart review and a part of the magic, go to marketmisbehavior.com/premium for more info on our premium members. I hope it pays for itself many times over with your improved decision-making and better performance. So check it out there. Make sure you use the code YouTube when you check out for a special deal on your first 12 months on any plan. What we talked about in the monthly chart review, by the way, is the long-term trend has clearly been favoring stocks over bonds. Not debatable over the last 5 years. I mean, clearly stocks have been the asset class to own relative to bonds. Now, other things like commodities, particularly gold, have done better on certain parts of this time frame, but generally stocks have been a really good place to be and bonds have not. However, we can see that that ratio is really starting to change. The last time we undercut the 200-day moving average was here in August and September. The fact that we held above the 200-day and quickly reversed higher was one of the more encouraging signs in this period, suggesting to us that we're probably back to a risk-on environment. That's the big question, is whether we get a repeat of this or whether we start to break down. Even in 2022, this ratio didn't get below the 200-day moving average because both stocks and bonds were kind of struggling during that period. This is an important chart to watch, particularly if you've hesitated to rotate to the bond side. That's a ratio I would certainly be following. Now, two ratios that came out of my conversation earlier today with Miss Schneider of Market Gauge, and again, we'll get that episode of the podcast out here very, very soon. But we talked about semiconductors. We talked about small caps. We talked about retail. We talked about transports, a bunch of different key market barometers. She follows what she calls her economic modern family. I just wanted to point out the fact that the relative performance of semiconductors, not good. And really for the last 10 months, it's been pretty ugly. Not that much, maybe 8 or 9 months. But if you look, this ratio peaked in June. From there, semiconductors have been underperforming the S&P. The small cap ETF has been underperforming as well. And that really, it's really been sideways for the longest time. But if you look at the last 4 months or so, from Thanksgiving to where we're at now at the beginning of April, small caps have been underperforming. And so, again, if you want to outperform the S&P, you have to own things where these lines are going up. So having exposure to semiconductors, having exposure to small caps, just not helping you outperform the S&P 500. So my answer would be, why own these when you can own things that are outperforming the S&P? And they're out there. It's defensive sectors, it's value sectors, it's financials, it's other things that we've tried to highlight on the show. So I would encourage you to focus on charts where the relative strength line is improving. Transportation is the top panel here. The bottom panel, retail. Again, these are two charts we went through in detail with Mish earlier. And again, what the challenge with both of these is they're below the 200-day moving average. So when you have this sort of environment, lower lows, lower highs, below the 200-day, in the case of retail, below a downward sloping 200-day moving average, I'm happy waiting for that to change, right? Look for that to break back above, because you get this sort of move, right? November of 2023, we're below the 200-day. The 200-day is sloping downward. It says, hold on and find something else. But when we finally break back above, when the 200-day starts to slope higher, that's when it tells you, okay, maybe this is an area that's starting to improve. So for now, these are two key kind of areas of the market to look. Retail, which is really a play on consumer sentiment right about now, not good. Transportation, really a play on travel and shipping to some degree, not good. I think that's a bad sign for those ETFs, but also not a great sign for the benchmarks as a whole. Now, what saved the day on a day like today is not retail or transports. We're back to mega cap growth stocks that managed to pound out a positive day. Meta was up 1.7%. Yesterday, we closed almost exactly at the 200-day. That's after Friday's close right at the 200-day moving average. Today, we opened below but closed back above it. So I think the real question for this week, does the 200-day hold? If stocks like Meta can't hold their 200-day, I don't think there's a lot of hope, at least in the short term, for a meaningful market rally. But if Meta can do it, maybe there's hope out there. So, you know what, bounce off the 200-day, making a high. These are things that would be really encouraging on this chart. Not there yet. I had a question on Alibaba. I think this came on the show yesterday. I didn't get to it during the live stream. Might have come on the replay on our YouTube channel. So I wanted to just briefly look at this. You know, what's the take on Alibaba? Well, generally speaking, China as a whole has done pretty well, right? Compared to the U.S., look at ETFs like the FXI, MCHI, pretty encouraging charts, to be honest with you. And certainly compared to the U.S., you know, by far an outperformer. Alibaba and some of these other names have pulled back a little bit. But if you think about some of the charts that we've looked at in the U.S., stocks below their 200-day moving average, which most S&P names are at this point, stocks where the 200-day moving average is sloping downwards. Here you have an example of a stock where the 50-day moving average is trending higher, where the 50 days above the 200-day, where the 20-day exponential moving average, which I'm not showing here, is above the 50-day. That's a scan I run regularly, looking to see if the moving averages are kind of in the right order, which means that the trend overall is pretty positive. And Alibaba checks all those boxes right about now. We gapped lower about 2 weeks ago, and from there, drifting lower a little bit. We're sort of in this sideways consolidation range. So if I was analyzing this chart from scratch, I would probably draw something like this. Let's find a fun color to do, like an amberish kind of neutral color. I mean, I see this as the general pattern, right? In Alibaba, it's not going up. It's not going down. It's sort of sideways. And we've had a bit of a pullback, and that's fine. That's after making a new high, and then it was a failed breakout. So we broke out, but then pulled back. We gapped lower. We're still trading lower, but we're not even below the lows from February and early March. So right about now, I think we're okay, right? I think this is a chart that's okay. Now, the problem here is we made a new high on weaker momentum. That's not the line I want. Made a new high on weaker momentum. That doesn't make me feel particularly good. So I would say the weaker momentum, what we call a bearish momentum divergence, not ideal. We're pulling back. We're still above an upward sloping 50-day moving average. For now, I'm kind of okay with it. This is an okay chart. It's a good chart, right? A not good chart or an ugly chart would be we start breaking below the 50-day. We start making a lower high. None of those things have happened yet. What would make it an exceptional chart is we consolidate here and we break to new highs. This is the kind of thing I'd probably set an alert above 145. And when that happens, it's sort of a lights out, sky's the limit type of breakout. Until then, it's sort of wait and see mode. But it's consolidating. And again, compared to a lot of U.S. names that are not consolidating, they're just going down. That's why on a relative basis, this is such a compelling place. Still a pretty good chart. And if I owned it, which I don't see a reason that I would not own it today based on what I'm seeing. I think it's still consolidating at worst right about now. So what charts are looking good in the U.S.? Cardinal Health, CAH. I was actually asked about this in the chat yesterday. Cardinal Health and another one, COR. This is CAH. We'll look at both of those. The short answer is great charts. Higher highs, higher lows, above two upward sloping moving averages. The RSI is generally in the bullish range. The relative strength is improving. This kind of checks all the Dave Keller boxes of a primary uptrend. What's great about Cardinal Health is this breakout right here. It's what we call, it's not a perfect cup and handle pattern, but it's pretty close to one where you have a rounded pattern here. Then you have the shallower pullback. This almost has a double handle, which is a little weird, but you finally broke above it here in early November. And then you retested the breakout level in December. Just a classic setup, pulling back to an ascending 50-day moving average. You know, it's overextended here, right? It's overbought, which means a lot of times when you have that, you pull back to an ascending 50-day, and that's more ideal entry point. So is today the day I might take an aggressive position? Maybe not. Maybe I wait for a pullback, but primary uptrend, very, very good. Same with this other name that was asked, COR. Very similar configuration. I think this is a strong chart. If I'm looking for an actionable entry point, I probably wait for a pullback and buy sort of a higher low, pulling back to an ascending 50-day moving average, pulling back from overbought conditions to get more where the RSI is down around 40 or 50. That's often a little better entry point. But generally, the long-term structure quite strong. With both of these, they had consolidated and they're starting to break out. And I think that's what's compelling in healthcare. A lot of the healthcare names were down today, as we mentioned earlier. But what's interesting about a lot of these charts, healthcare was sort of an underwhelming sector on a relative basis because of these sideways trends. And that's why the relative performance is negative in the second half of 2024. But look at how all of that has changed with some of these charts going into this year. EXC is another one that was asked about on our YouTube channel, so I'll just quickly address. Utilities look pretty good. And by the way, we did our top 10 charts for April 2025. That just came out yesterday on the Stock Charts TV YouTube channel. I'll include a link on our YouTube page just so you can get to it. But just go to Stock Charts TV. It's the most recent video there. Grayson, Rose, and I each shared 5 names to combine. It was a really fun conversation. Good to be back in the Stock Charts TV studio. Good chatting with Grayson and good talking about indicators and markets and themes and all of the above. We did not highlight Exelon, but I did bring a different utility. So watch that to see which one. But EXC, I think, is just a brilliant chart. Think of a chart, I think this was just a couple charts ago. This was Alibaba, kind of this big run and then consolidation, and you wait to see when it breaks out. It's almost like a bull flag, but like not perfect, but kind of. This is almost a perfect bull flag pattern, right? We have a big run higher, and then you have slightly lower highs, slightly lower lows, and then you break above it. I mean, that's just a classic breakout pattern. And this is in a pretty higher yielding, kind of low volatility utility company. This is why utilities are outperforming year to date. Charts like EXC that are just continuing to go higher. This was a wait and see, and then I think confirmed with a breakout to the upside. Good chart. TJ Maxx is one of the 10 that we highlighted on the show. This is one that I brought there, and I highlighted it as a not quite ready, but really, really close. And what I talked about was in this sort of chart where you made a high in November and December, we retested it in February and March. This is where I set the alert to look for a breakout above resistance. We broke below the 200-day, which all of a sudden made this chart look pretty vulnerable. However, it quickly regained the 200-day, bouncing off of it this week, and now aiming back toward those previous highs. A break above 127.50, clearing that resistance. RSI pushing above 60. That would complete kind of the bullish rotation here. Right now, it's consolidating. This is TJ Maxx. Not all retailers look kind of this promising as a potential breakout candidate. I think if and when it breaks out, that's a pretty compelling chart. Until then, I wait and see, look for that trigger to potentially emerge. All right, that's it for the chart review. I'll take a question briefly or two, and then we'll finish it for the day. 3P Investor, thanks as always for watching. You asked, Intel, is that a triple bottom between December 2024 and February 2025, now exhibiting higher lows? Will it fill the gap that occurred in August 2024? Shall we take a look together? All right, you're looking at Intel. Triple bottom is seen between December 2024 and February 20. Yeah, you're talking about these 3 points right about here. Now exhibiting higher lows. Agreed. Will it fill the gap that occurred in August 20? Yeah, I see what you're saying. All right, so we're looking at this part here. So let's kind of highlight this. So anytime I have gaps on the charts that I review all the time, I usually just draw like a big horizontal rectangle kind of pattern, just to remember where we're at relative to that gap. Until the gap is no longer relevant, I usually keep that on the chart just as a visual reference so I know where we're at relative to that key. But this was a big gap that occurred here. I mean, gaps are usually kind of smaller relative to the rest of the price action. And it's like this is why I kind of keep it, because often the market will trade back up into that gap, but then that serves as like a resistance range. So until we clear the gap, it's sort of like I'm not convinced yet. So we've traded like to the midpoint of that gap, and that's it. Now we're at the lower end of it. So I think that's one thing to think about. Another thing I would say would be this kind of really interesting pivot point right about here as a shorter term level. I'm looking at this level. This is around $22. So look at how many times we've tested this. This is the lower end of the gap. We traded up to it a number of times. Then it became support. Then it becomes resistance. Not surprisingly, we're kind of right there yet again today. So this is what we call a pivot point. This is one of those lines you could draw a horizontal line. We just keep hitting it a number of times. So what I've learned with a pivot point, you just want to kind of know where that level is and be aware, because when it happens that many times on the chart, I'm not the only one that kind of sees that symmetry and then starts to think, expect it, and then even start to place orders around those levels. And that's what can often create that support or resistance, I would think, that you sort of see. So, I mean, here's the thing, right? With the chart of Intel, I mean, I think the real story, to be honest with you, is here. If you're a swing trader, I mean, betting on these short-term swings, betting on this range is certainly the way to do it. So buying the lower end of the range, selling the upper end of the range, kind of playing these multi-day, multi-week swings, that's been pretty good. The longer-term structure, though, which is what I want to try to what I want to try to get to as much as possible. All right, I'm disrupting my whole annotation. I had such a thing going. All right, so here we go. I was looking at that line right there. Then I'm going to go to kind of a new thing to show you. This is what I'm getting at. The larger structure is key, right? Here we have a distribution phase of lower highs and lower lows. Here we really just have a consolidation phase, right? A sideways trend. What I'm looking for is this, right? Like that sort of move, which is a break above 26. We have a distribution phase. We have a consolidation phase where we're really at an equilibrium. This is the market telling you this stock's worth around 22, and we're just kind of overshooting and undershooting that midpoint and just kind of fluctuating in this range. When we break out, that's the real message, right? We've stalled above the 200-day a couple times. We've stalled trying to get above 26. For me, a break above 26, that's where you really have the opportunity to, have significant gains. In the middle here, this is a trade, not an investment. That's where it becomes an investment. So I think it's important when you're looking at key support and resistance levels, I would say when in doubt, zoom out, like bring in a little more data and just really think about what sort of phase we're in. Because if a bunch of institutions start accumulating intel, we're going to break above 26. That's how you know, okay, this has the potential to really have a sustained uptrend. Until then, I'm kind of waiting. That's again where I'm setting an alert. I think I've written down set an alert on Intel at 26 probably 3 different times in the last month or two. I'll check and make sure that alert's still going, but that's how I would generally think of the chart of Intel right about now. Boy, that's it for today's show. Some really interesting questions. We can't get to all of them, but I'm going to throw the rest in the mailbag, and hopefully we'll get to it at the end of the week on Friday's show. Again, end of this week is going to be interesting. I'm traveling to San Francisco for the CMT conference. I'll be heading out Friday morning, but I will get a show out to you during the day at some point on Friday, and then back to actually on spring break next week. We're going to be on location in the Olympic Peninsula in the Western Washington, other mountain range on the West Coast. But I am planning to do a show from there. Maybe I'll get my son Henry to be my cameraman at some point. We'll try to have fun with it as much as we can. But in the meantime, have a great evening. Good luck with tariff week. I'll be here along the way to help you navigate. But remember, it's always a good time to own good charts. Have a good night, folks.